without further ado, I'm gonna mention the names of my colleagues in the panel here today. We have Elizabeth Alves, COO of MCA, a large-scale infrastructure and renewable energy that has a large renewable energy portfolio across Angola and Africa. Yeah. Samuel Zekri, founder and CEO of Hydroneo. Rodrigo Madrazo, CEO of EDFI Management Company. Robert Tenso, CEO of African Investor. And Andrew Masura, Director for Southern Africa at AfSEM-CMP. Myself, I haven't introduced myself so far. I'm José Mestre. I work for the Get Invest program, which is a European program that has been working across Africa to help turn clean energy projects into investments. So far, we have supported close to 700 companies. We have mobilized over $500 million euros in private capital across different sectors, from CNI to large IPPs, solar, wind, but also with companies that provide access to energy in rural areas. So, having said that, I'm going to start with the discussions. The first question will go to Hubert. What are today's biggest constraints and most promising opportunities for scaling private sector investment in renewable energy and in the green transition in the continent?
No, thank you very much, Chair, and good afternoon to everybody. It's a real pleasure to be here. As the Chair mentioned, my name is Dr. Hubert Danso. I'm the CEO and Chairman of Africa Investor. We are an institutional infrastructure investment platform for institutional investors, particularly African pension and sovereign wealth funds. I personally sort of work very extensively in the sustainability space. I chair the Sustainable Markets Initiative Africa Council, established by His Majesty King Charles III, which brings together about 300 CEOs from around the world to use our own balance sheets and ecosystems to allocate to the sustainability agenda. I also was the first chair for the African Union's Continental Business Network, which really brought together the private sector to drive the cross-border infrastructure project, particularly those as part of the PEDA program, and I also chair the African Sovereign Wealth and Pension Fund Leaders Forum. My perspective is pretty focused on the role of the institutional investment community, the long-term investors. I have a pretty narrow view, actually, because I think the numbers are pretty staggering. When you think about the whole area of renewable infrastructure, the low transition economy from a financing needs perspective, it's way out of the range of development finance. Let's be honest. I mean, if you look at the pools of capital, the whole global collective balance sheet of multilateral development banks is less than $2 trillion. But yet they're driving the private capital mobilization agenda. Does that make sense? Maybe not. And we feel that as the institutional investment community, we've been slightly... Is that the multinational development banks controlling my mind? Well, anyway, I'll continue. But the point I'm trying to make is that in all of the agendas, as we talk about renewables, green infrastructure, and this agenda, Africa alone needs $3 trillion for our nationally determined contributions. How can a global balance sheet of 1.5 trillion, mobilize and crowd in institutional capital? So I think it's time really for us, and that's the decision that we've taken as the institutional investment community, pension funds, sovereign wealth funds, and others, that we really need to play a bit more of a leadership role. I mean, we've even gone so far as to characterize, and you asked me about the challenge, we've even gone so far as to characterize the problem as a systemic, on the continent, we think there is a systemic multilateral private capital mobilization market failure. And the numbers, we believe, bear that out, because we have a very important role to play, and I think we all have to be figuring out how we can all work constructively together. And, you know, if you look at the private mobilization ratios, according to the mandates of the multilateral development banks on the private mobilization agenda, they're supposed to mobilize $10 of private capital for every $1 of MDB finance proposed. That's in the Hamburg Principles. It's in so many of the other initiatives that I was involved with. I sat on President Macron's new Global Financial Pact Finance and Private Sector Task Force. We've gone through this several times from many different angles. And there, the actual result is that instead of mobilizing $10 for every $1 that's provided, is actually, according to the G20 CAF report, Capital Adequacy Framework report, the mobilization ratio is actually 20 to 38 cents gets delivered instead of $10. So I think there's actually a crisis there. We think it's a market failure. We don't think that, you know, soft tones of let's reform are going to get us there when the pace of this crisis is right on our doorstep. So we think to get to scale, Africa must really take a different view. We must send a very different market signal to the global investment community that, you know, Africa is a competitive destination for all of these new green technologies, renewables, green infrastructure, with our superabundance of all of this natural capital. So our sort of mantra is that first things first, in this competitive world, we must stop trying to make investment developmental. And we must make development investable. We need to flip this on its head. We're competing with all sorts of global opportunities. It's not just a little nice pocket of opportunity for a certain part of the market. And we think that if we can change that narrative, we can more smartly align the $3 to $7 trillion worth of nationally determined contribution projects and with the 300 to the 425 trillion pool of institutional capital, instead of relying on the $1.5 trillion balance sheet and deluding ourselves that actually private capital can be mobilized at scale. So we believe that governments should really shift their mindsets from a project logic to an investable asset class and institutional investor-public partnership mindset. Because we believe that's the only way that you can get the dual benefits of, one, being able to mobilize private capital at scale, and two, being able to deploy it at speed. What are we really saying? We're simply saying that, you know, you talk about renewables, then you talk about green infrastructure, but we allocate to asset classes. There's a certain way as financial investors that we deploy capital, and it's not aligned with the way that a lot of these projects are designed by the institutions that hope to crowd us in. So this is just good friendly advice that, you know, with all of the goodwill of how institutions that don't allocate on a long-term basis are trying to crowd us in, perhaps you might want to listen to us about how we operate and what our investment policy statements and mandates allow us to do, and then hopefully we can really help each other. So it's really about how do we establish, in our view, African green industrial infrastructure as a globally competitive investable asset class. So that doesn't mean make the project bankable and you'll have funding, because there are many bankable projects, but then you've got to compare them with all of the other opportunities out there in the rest of the market, and we have a fiduciary responsibility to pick the best and the most productive and market aligned. So we've established, and I'll just end up quickly here, so we've gone ahead as the African and the global institutional investment community as a collective, working closely with the African Union, putting on our universal owner hat, which is essentially saying that as universal owners owning public and private markets, we can't invest in one part of the world hoping that we are going to be shielded from the negative effects of the other. So we've established something called Green Alpha, which is our own definition and our own platform, which is under development now, of African green industrial infrastructure as an investable asset class. It was launched at the Africa Climate Summit 2 in Addis Ababa just recently. And it's really designed to support the Nairobi Declaration, which is the first time that African heads of state came together at the first Africa Climate Summit and said, you know, as sovereigns, our strategy for the continent around the transition to the low carbon economy and our NDCs is going to need to be led by green industrialization. And I think where we've come in to play our role is to say, how do we make that green industrialization agenda investable. And that's where we've essentially come up with the Green Alpha program. It's based on the African Union's 5% asset allocation agenda and their institutional investor public partnership platform. And the institutional investor public partnership platform was really just borrowed, I'll be honest. It was really borrowed from how the prolific pension funds in Canada and Australia allocate to infrastructure as an investable asset class. They call it PPPs, which is pensions public partnership. How do you sort of enfranchise long-term equity to be able to participate in infrastructure on a cross-border basis? So because we are sovereign funds, insurance businesses, and pension funds, we just basically use the framework as an institutional investor public partnership. So Yale, they pioneered venture capital, as an endowment. The Canadian infrastructure funds pioneered infrastructure as an investable asset class. Norwegians pioneered responsible investment as an asset class. So we're simply saying, the African institutional investment community, working with global partners, are pioneering African green industrial infrastructure as a globally competitive investable asset class. So perhaps I'll stop there just to plant the seed, just to say that, we hear a lot about the institutional investment community are not interested in participating in infrastructure or in Africa. I think it's quite the contrary. I think what we're basically saying is if we keep having development finance mindsets trying to structure projects for long-term asset owners, it's probably not going to work because it hasn't worked. But what we're saying is if we can work with you around establishing asset classes and really beginning to look at blended investment as opposed to blended finance and really aligning it with some of our mandates, we think that there's an incredible opportunity to be able to crowd in capital at scale and creating a regulatory environment that will enable that capital to be deployed at speed. So I'll leave it there. Thank you.
Wow, it's a lot of food for thought. Thank you, Hubert. Hello. Is it working? No. Hello. Okay, good. Well, thanks a lot, Hubert, for it's a lot of ideas, a lot of challenges. And a lot of opportunities, yeah. It was in my question. Rodrigo, it was not planned, but would you like to react on what Herbert mentioned, and perhaps also suggest what coordinated actions could DFIs, government, private actors could do to de-risk and also to scale up investment in green infrastructure and in renewables?
Yes, of course. Thank you very much, Jose. Good afternoon, everyone. And if I may, I would like to say a few words about my institution and my network of institutions, the European Development Finance Institutions, or the European DFIs. They are state-owned development finance institutions that belong to different European member states. And basically they have 2-3 features in common. They focus only on the private sector. They interpret the private sector as an engine for sustainable development. They only invest in emerging or frontier markets. So those European DFIs or the European Development Banks set up 2 institutions in Brussels, an association that represents them and is in charge of disseminating practices among the members, and also a management company, the AfSEM Management Company. I had the pleasure to head it. And it is aimed at providing financial services that complement the financial offer of the European Development Banks and that enhance their activity. And maybe this is setting the bar a bit high, maybe even a bit over the top, but please allow me to say that I think this is maybe the most relevant experiment in the world in the domain of coordination among development finance institutions and using blended finance. And going or addressing your question and also some of the comments of my colleague, yeah, let me elaborate on how we coordinate and how we align not only the different European development finance institutions, but also government, the European Commission, and private companies in the domain of renewable energy, or if you want, in the domain of energy transition. Just to make it simple, we basically focus on 3 different segments. The first one is about market creation. And when we refer to energy, we are referring to granting access to electricity. You know that according to estimations by the World Bank, in Africa there are about 600 million people without access to electricity. Normally population in rural areas. And here, I'm afraid there is no asset class that can do the trick. Simply because those type of projects, normally off-grid generation plants, clean cooking solutions, they are not bankable. And as a result, concessional money is required. So the way we work here is the following. Our shareholders, the European Development Finance institutions, they use grants or pockets of concessional money coming from the national government or coming from the European Commission. This is the case of the AfSEM-CMP because we manage a huge program on the space of market creation for access to electricity called Electrify, or the Electrification Financing Initiative. And the goal, in market creation, as I mentioned, is trying to facilitate, trying to grant access to electricity to millions of people through grants or through equity or equity-like investments. But knowing in advance that the probability of losing the investment might be 20, 30, or even percent, or even more. So this is market creation. The second segment I would like to refer to would be security of supply. This is a second stage. And here we are talking about basically on-grid generation projects that tend to ensure security of supply and making electricity more affordable. Those projects can be bankable, and here, of course, mobilization of private capital is the key to address big projects, big infrastructures. Normally, European Development Finance institutions can do it on their own, even when projects are risky, through different types of debt transactions. Sometimes projects are on the limit of bankability, and here a nudge is required. This is why, from the point of view of asset classes, we don't use only debt, we also use guarantees. And this is a key instrument to de-risk the investments undertaken by European development banks or other commercial or other commercial investors. And I'm very proud to say that here we have managed to line up all the stakeholders: governments, European Commission, AfSEM-CMP, European DFIs, private companies, meaning that we use guarantees provided by the European Commission to de-risk the investments of European DFIs and the co-investors. And this way we can address difficult projects, big, large-scale projects. I can give many examples in Africa. Just to say one, we're going to support this big hydropower in Malawi, Patamanga. It will be more than 1.5 billion euro. And the third segment is expansion. This is, of course, bankable projects, normally on-grid, of course, aimed the same to allow population to have affordable access to electricity. And the problem we face here is that sometimes tickets are very, very high, and as a result, doing some kind of risk spreading is necessary. And here our solution is syndications. Asset class, always debt, of course, but risk needs to be spread among different investors syndicated in a deal. And as a result, we use our available vehicles. Among the European development banks, we have two of them that work very well. ICCF, the Interact Climate Change Facility, and the Friendship Facility. So this is the way we try to coordinate the different stakeholders around the common goal of granting access to electricity and making it more affordable for all populations.
Thank you, Rodrigo. Very interesting to know what's stage in the DFI, in the European DFI world. Andrew, do you have any reactions to what our two colleagues mentioned just now, and also in your view, perhaps you could share how green investments and renewables could be scaled up even further to match what the continent needs?
Thank you so much. Yeah, so first and foremost, before I have to agree or disagree with my colleagues, it's just useful to spend a minute to introduce AfSEM-CMP, which is the institution that I represent today, as a development finance institution which was created by the African Union to support Africa with trade, supporting trade and financing trade. Trade between Africa and itself, and between Africa and the rest of the world. So as we stand here, I think there is all the tools that we need among every single one of the people on this panel, as well as in the room, to really solve this problem. I say this because what all the previous speakers have alluded to is a fact, but probably a fact which has got to be put in a certain sequence. Let's take Hubert's case, for example. He has spoken very eloquently about investable asset classes and needing to bring scale and speed in intervening to the problems at hand, the problem of energy deficiency and many others, including transmission problem for electricity. But having said that, that presupposes that you actually have got sufficient projects which can be the recipients of the strategy, if I could call it that, which has been made mention by Hubert. So what I would like to spend time on, and which I would like to appeal to the Global Gateway, African Union, the DFIs, is just to spend more effort in the space of project preparation. The amount of projects that exist on the continent that I have personally have looked at and set aside are far too many to mention. And yet, at the same time, the continent still is in a energy poverty state. We even are told that by 2040, the electricity demand would triple. And yet today we still have a deficit. So by 2040, this problem will be 3 times what we are experiencing today. We are also told that the Global Gateway has set aside 140 US or Euro billion for sustainable infrastructure projects. So the reason why even this number is not in the order of trillions, but we need to exhaust it in the first place. Why is it not being exhausted? It's not being exhausted because we don't have bankable projects in the continent. So we need to re-strategize to equip those entrepreneurs, those sponsors, and not just with funding, but sometimes with expertise. We come with different incubation programs from markets elsewhere, which experiences can help to quicken the learning curve for the establishment of power producing projects. So that's the first call, and it also extends to the next intervention that I would recommend, which is to increase the stock of transmission projects. We are also advised through wide research that 60% of the electricity that's generated on the continent is lost through inefficiencies in our transmission lines. As they stand today, 60% of electricity is being lost. So we need to revisit and do so as a matter of urgency to attend to the losses. If we were to remove losses from transmission lines, we could have a different story in terms of electricity penetration in the continent. Having said this, and my last parting shot at this point is just to speak to the need to create visibility to the opportunities, the intervention that the EU and African Union, the DFIs have made over years. Quite a lot of work has been made in terms of the studies. When you look at the continental power system master plan, it gives you all the work, all the information that one has to do, and various other studies. There's also funding, which I've already mentioned, which is looking for bankable projects. But in the last 2-3 years, I've probably looked at about 20 electricity projects, which all don't appear to be alive to the opportunities that we might be aware of in this room. So there's a lot of market awareness that needs to happen. And it just reminds me of a previous conversation before we started this panel, that a lot of things may have been said in previous years, but there's never love lost in speaking a good many times, because then that's how you're creating the awareness, and that's how you get to have others to benefit from what is available as interventions. Thank you, Jose.
Thank you, Andrew. It's very interesting. Yeah, I also agree that there is money available. There is just not a lot of projects that are bankable. But Samuel, I wanted to ask you now. You work with hydropower, and you're down the river from all these guys here that have spoke before you. Do you agree with what they said? What is available? Is it sufficient from an entrepreneur like yourselves and like your competitors? And what are the biggest constraints for you in developing a project, but also in getting that project financed?
Thank you, Jose. Before starting, maybe I introduce a bit my company. I'm going to give maybe a less high-level view, but more a view from the field as an IPP and a developer. So I'm Samuel Zekri. I'm the founder and CEO of Hydroneo. Hydroneo is a European hydropower IPP developing projects across Africa. We have projects under operation and development in Kenya, Uganda, Rwanda, Tanzania, Burundi, and now Gabon and Sierra Leone. So, and we're totaling a capacity of 400 megawatts. We expect to double this capacity in 5 coming years. So our mission is quite simple. We provide electricity to the national grid that is clean, affordable, and stable, because hydropower provide base load, so we kind of stabilize grids. And this is to support, obviously, industrialization, long-term economic growth, but also government sovereignty, because an hydropower plant lasts for hundreds of years. So after you amortize the asset, the infrastructure goes to the government, and you produce for like 3-4 cents. So when we talk about government sovereignty with hydropower, this is what we are talking about. But also we create a lot of value locally. Compared to other technology, when you build a power plant, it takes like between like 3-4 years, and civil work really creates value locally, because you have construction, you need to do road rehabilitation, so you create like thousands of jobs. It's not only jobs for the construction, but also for the operation, but you create like restaurants, shops, and everything around the project. So this is so now maybe to address your point, Jose. Sorry. I think what we need today to really build bankable pipeline. Andrew was talking about the lake of bankable projects. What we need today, maybe 3 things. First, we need standardization. You go from one country to another, you have different PPAs, not always bankable, you have different permitting process. And I think a marketplace like or a Euro-Africa partnership with the Global Gateway aim to bring a kind of marketplace, like a kind of toolbox. And inside this toolbox, I would say we need first standardization. Just to give an example of what could it be, Get Fit program in Uganda for hydropower. In 5 years, we developed, it has been deployed like almost 20 projects with the support of a team, dedicated team, standardized PPA, streamlining the permitting process, supporting the development, and it has been a huge success. So this is the type of initiative we need. Maybe second, de-risking tools. We were talking about de-risking a lot during this morning, for example, but we definitely need some tools like to cover the FX risk, for example, political risk, off-taker risk, and this is what we really need, because at some point you develop your project, you reach financial close phase, and there is no real tools to address those issues. And if we have this into the toolbox, the Global Gateway toolbox, it's completely streamlined the thing. And maybe the last point is early stage development support. Like, I think 80% of the project die because of lack of development support. So early stage development is supported by developers, but I mean, there is definitely not enough resources to build the project portfolio, the bankable project portfolio that we need. And so I think we should think about this and have envelope to be invested alongside with developers, so both are taking risk together, and so that way we'll I think we can address those issues.
But is that for hydro, or is it the same for, let's say, photovoltaics?
I think globally, it's globally the same. Maybe the difference with hydro is the period for development is a bit longer, because from a technical perspective, it's a bit more complicated. And but globally, if we have this toolkit for renewables, it will help energy mix. And you need hydro before thinking about solar. You need to have hydro because you need your base load to be able to integrate other renewables. So so technically, hydro can allow other technologies to be implemented. So I'm promoting a bit hydro.
Thank you, Samuel. Well, now I have a question for Elizabeth. I learned recently about MCA and their experience in developing a project in Angola, which was very, very interesting and, in my opinion, benefited a lot both Angola but also Europe, a couple of European member states. So, Elizabeth, I'll invite you to share your story here in Angola.
Okay. Thank you, José. Thank you all for your time. It is a pleasure to be here today. I'm representing MCA. MCA is a Portuguese development and EPC company. We are in Africa since more than 20 years, and I'm responsible for the infrastructure sector, and I'm the country manager in Angola, where we have our main projects ongoing. So as a development and EPC company, MCA's top priority is to design and implement projects in a sustainable and responsible way to apply them for green and social loans. And why is that so important for us? Because this allows African governments to access to export credit finance and at a very favorable conditions. And this is very, very important to implement large-scale projects like electrification projects. One of the main challenges for a development and EPC company when working with ESG-driven projects is the differences in standards, frameworks, and expectations between the lenders' countries and the project owner country. A good example of that is our rural electrification program here in Angola that was developed by MCA Deutschland with the tremendous support of Hiller Hermes, who we thank, also Commerzbank, AfSEM-CMP, and all the banks involved in this transaction. But let me briefly introduce the project for you all have a clear picture. We are electrifying 60 remote villages, which include 46 full renewable off-grid systems with solar generation and lithium-ion batteries. The program is a full package because it includes generation, storage, distribution, installation of smart meters covering more than 200,000 homes and reaching out to 1 million people. We designed the program for African specific conditions, focusing on robust components, simple and reliable O&M, training and empowering local technicians, and construction solutions well adapted to the logistics of these remote areas. The project or the program is progressing very well, and we are on track to deliver the first fully integrated 100% renewable mini-grid by the end of this year in Kazombo, a remote community in eastern Angola. The Kazombo project includes 25 megawatts of photovoltaic generation, 75 megawatt hour of battery storage, and 16,000 household connections. This is quite a dimension for a mini grid in Africa. And for us to be able to implement such a large project, we faced many challenges during the development phase and the implementation phase, such as many of these sites are extremely remote. Some of them are not accessible during the rainy season. We do not have in some sites internet or phone network. We have a lot of difficulties to collect basic information like number of people, number of houses, number of business, energy demand. No aerial photogrammetric surveys, meaning that we had to do it ourselves to be able to understand land, occupation, and possible impacts, and the list could go on. So it's very difficult and very demanding to implement and develop this type of projects, but in the end of the day, it all comes down to a company's values and purpose. Implementing the projects in this perspective, in a structure of development and EPC, maybe it's harder and less profitable for an EPC company, but at the end of the day, it's also more sustainable and responsible. And this is very important in this type of loans, green and social loans. So how we tackle all these challenges? First, what we do not do. We do not ignore ENS challenges, and we have a responsibility for future generations, and this is a core value to MCA. So what we do instead? Capacity building in the communities where we work. We work with the lenders to secure these early study costs, namely ESG studies, and we developed the project from day one, always in our mind with ENS. ENS is always at the center. So that's why this is very important to implement this type of projects, and of course these financial partnerships are always a key for success also.
Okay. Thanks a lot, Elizabeth, for sharing that with us. Andrew, you're familiar with this project. Do you think this is an interesting model to be applied in other countries? Would other African governments be willing to develop projects in such a way?
Absolutely, Jose. I think the concept itself is a game changer because it attends to the reversal of urban migration. That is one of the problems we have been having, and Secondly, also avoiding the problem of transmission lines that we mentioned in terms of having to transport electricity over very long distances. And it is a solution which we would like the rest of Africa to embrace, because we still have countries where, again, about 60% of their populations are not on a grid. It's a lot of work, but once the work is done, as done here in Angola, through the support of the government, MCA, the DFIs, and ourselves as AfSEM-CMP, you can actually have a good night's sleep knowing you have changed a lot of lives. So absolutely yes. Thank you.
Okay. Thanks a lot, Andrew. Very encouraging. Herbert, I would like to come back to you. You mentioned a lot of opportunities in your speech. I invite you to take like a couple of minutes to prioritize them so that we can take them home and see what we can do about them.
Thank you very much. I'm not sure you want to take them home very big problems, but yes, let me respond to this, because there's a lot of myths that keep getting thrown around. I a couple earlier. Institutional investors won't invest in early stage projects or won't invest in climate. I don't think that, personally, I don't think there is a pipeline problem. I think there's a structural territorial issue. We studied over 33 project preparation facilities operating in Africa, and we found it's the way that they're designed that's actually the problem. We had developers coming to us saying that sabotage. No, anyway, they say we've got this great project, sold our more. No, okay. I must be saying something interesting. I've got a great project. I've invested in it for so many years. I finally found a development bank that does project preparation. I go to this bank. I've shown them all of my work. I've shown them that I've put X million friends and family money has gone into this, and they're asking me to take a very big haircut on all of the work that we've put in to come into the project as a development finance institution on a project preparation facility. And then on top of it, they say, we'll do, say the budget's 5 million for the rest of the project development work. And this is a project preparation facility. They then say, okay, fine, you put in 2.5 million, we'll put in 2.5 million. And by the way, you spend every dollar of your 2.5 million from a development finance institution project preparation facility before we put in our $1. This is how the private sector is treated. So I think there's a philosophical issue. It's a structural issue. It's a very unreasonable issue that the way that the private sector, from the SME developer right up to the larger player, is dealt with. And I think I think creating more project preparation facilities is not the issue. Within our own portfolios as institutions, we already have companies that have projects getting backed up and backed up and backed up, not getting the PPA signed. So there's a lot of projects already in our portfolios. There's a lot of technology already in our portfolios. But if you go for an NDC project, for example, you can't originate, as the private sector, an NDC project, because it's not going to be UNFCCC classified, and it's perceived to be between Ministry of Environment and UNFCCC. So I think the structure needs to change. The private sector can come in at a very early stage. We have many developers that could come in and solve a great number of the project development requirements. We don't call it project preparation. That's just a facility name for something else. We call it project development, taking it from concept right through to financial close. So I will just end by simply highlighting another point, and I'll make it very simple because it's a costless action that could have priceless impact. And they've just been discussing it. We just put out some work on it around the G20. It's data. Our institutions can allocate a lot more if we have a different view on risk. Everyone's talked about risk, the perception of risk versus actual risk. There is the Global Emerging Markets Database that sits with a number of multilateral development banks, and they are not sharing that information. And as a consequence, governments are spending about $15.6 billion each year in excess interest. But the interesting thing for us as asset owners is that because we don't have access to that data, and we've been under-allocating to certain markets, Africa and emerging markets, we over the last 2 decades have lost about $6 trillion in unrealized returns when you backtest the data. So the one thing I would ask the Commission to do is to really act on a directive that the G20 heads of state have already given to the GEMS consortium to democratize that data. It will give us a much different perception on the risk that will be able to go into transition-related assets. And I think that's just, it's a costless action that can have priceless impacts. I don't want to give everyone complications, but let's see, if we can't do the simple things that are costless, then there's no point in going into the complex ones. Thank you.
It's very interesting, and thanks a lot, Hubert, for that, for those recommendations. Rodrigo, do you share the opinion about from Hubert that there is not a pipeline issue? Do you do you disagree? And what's also your view about on the investment hub that was mentioned in the high-level panels this morning? Maybe try.
No. No. It depends, and I'm going back again to segments. If we go to market creation, if we go to the kind of projects Elizabeth was describing, in our Electrify fund, we have 50-something portfolio companies. Two-thirds are struggling to survive. And sorry about the pessimism, but the last mile in all industries is very difficult. It's not just about structuring the project. You can have the best structurer there, but if under normal conditions a cost cannot be recovered by a certain by a flow of income that is relatively predictable, the project is not going to work. And this is why I insist. Here we are in the domain of grants and concessional money. And with it, it is very difficult to mobilize. And let me go back to your initial comment and also offer a challenge. In high-scale projects, sometimes it's difficult to bring institutional investors. And if we go out there and tell a pension fund or any other institutional investor to pitch in, the first question we're going to get is, okay, give me the asset class and the rating. Because normally pension funds and institutional investors are subject to solvency regulation, and they are going to answer. I'm only interested, at least in Europe and in the United States, they are going to answer. We are only interested in AAA or AA rated projects. And if we are investing in a project whose probability of default is 15, 20%, even 10%, how are we going to convert this asset into a AA or AAA rated asset? It's difficult, and to do so, we need to put a guarantee on the table. And sometimes, or normally, investors or pension funds will require, I don't know, 50% first loss coverage, or even, I don't know, 70, 80% pari passu coverage. So the ratio here, in this example, 70 or 80% coverage, is the mobilization ratio is only €1 per 80 cents. At the end, we are very, very far from mobilization targets. And this is why I think the development finance community is underperforming and under-delivering in the mobilization targets that were launched 10 years ago in the Addis Ababa United Nations Conference.
Thank you, Roberto. My next question is to Samuel. Samuel, if you had my question is, what can an African government do to attract you to come to their country to develop hydropower projects? What attracts an IPP developer to go to a new market where the developer has no experience in?
That's a good question. I think as a developer, as an IPP, what we are looking at is maybe clarity and predictability, and if a government can do something about this is by showing that the path from like site identification to financial close is clear, meaning we need a readable permitting process. As you know, like a development phase for an hydro project is like between 3 and 6 years, sometimes more for bigger projects. We've seen more. But during that period, effectively, we need a clear permitting process telling us, allowing us to predict how long it's going to take. So this is, yeah, for the regulation. And then we definitely need bankable documentation, and so the legal framework should be compliant with financer expectations, and so we definitely need like bankable PPA, the necessary guarantee to make a project. I don't know how many A's we could get, but effectively this is the type of things we need from government to come and develop a project.
Thank you, Samuel. Before we have one question, a last question to Elizabeth before we start. We give the floor to the audience for some Q&A. Elizabeth, your development and EPC model is very interesting. Perhaps other countries would like to apply it as well. What, in your view, how could we facilitate this model to be applicable or to be used in other countries? You know? What could, let's say, the governments or the export credit agencies or I don't know, DFIs do to see such projects being developed in Africa?
What I can say is what we have been doing. We identify the needs in the country, so we need to understand the needs of the government related to electricity, to be able to find the best solution, because this program that we put together here in Angola, it's working very well because it's tailor-made for each one of these locations. So we need to be aware of the real necessity of the government to be able to study the best solution, and for them, and after that start doing all the studies, the early studies, the development studies that will allow the project to be bankable by an export credit financing. And this is the most important, is that these type of projects are scalable. They can fit to a small community, but they also can fit to a larger community. So if a government, an African government, needs to increase rapidly and affordably their electrification rate, this is a good solution for them. Development and EPC approach, allowing the developer to develop the best solution for their community and allow them to apply for export credit financing.
Thank you, Elizabeth. I'm now inviting the audience to ask questions. Please be very specific and mention to whom you'd like to ask the question to.
Thank you. My name is Oscar. I'm from PLMJ here in Angola. My question actually is not mine, it's from Rodrigo, which is basically more a provocation to the AAA and the standardization. So I would like to hear from, I guess, Herbert, how do you answer that conundrum that was very well put by Rodrigo, which is how do we, sensitize, make a balance between the requirements, the very strict requirements that are required to get this type of financing. And I guess that speaks a little bit about the tone and standardization that Samuel also mentioned, that is required. We need standardization. We see that the European Union has gone through the Omnibus project, which is basically deregularization of ESG, which makes a little bit more easier for companies to actually access financing. So I'm guessing the answer will be yes, we need less and less requirements, but I would invite you just to answer Rodrigo's question. So it's not mine, really, it's just Rodrigo's. I just wanted to kick that discussion, so thank you.
Oh, thank you. You take that responsibility.
Thank you.
I'm going to nominate someone to answer it.
Any more questions? Okay, one and okay.
Thank you very much. My name is Ekanem from Work Capacity Nigeria. Just going back to Herbert's concern about DFIs not allowing investors to make the move in terms of investing, saying, okay, if you want project development fund, you need to put in a certain amount, and you must put in all before putting our first dollar. How do we solve that? Because I see AfriEximBank is there, and you didn't mention any DFI. I'm sure you're being careful not to mention the names, but we see that. We see that happening with other, apart from AfriEximBank, other DFIs. How do we solve that problem? Can you share that with AfriExim and other DFIs in the room? Thank you.
Thank you, Lionel Dieu, Agrify, fee management company. That's Rodrigo. I have a question to Mr. Danso. You mentioned in the beginning of your introduction the mobilization and the $10 that moved to 37 cents. 32. All right, it's even less than what I thought. Can you elaborate a bit on how you moved from 10 to 32 cents in terms of analysis? What happened? You were thinking that the mobilization was higher than what it was in practice. Can you elaborate a bit on the shift from one figure to the other?
It's a range.
It's a range.
Between 20 cents and 30 to 238. It's the higher range.
All right. Okay.
That's the actual mobilization.
Right. Got you. Yeah.
And the 30 plus cents are the outliers. Average is closer to 25.
Okay.
Actual point, which includes the former treasurer.
Thank you.
Yes. Well, all I can say is I think you answered my answer for me in terms of the standardization, but there were, and I'm happy to share the Green Alpha report because it went very deep into a lot of these particular issues around, all of the regulatory compliance related issues and the actual constraints and the myths and what can actually be done. And a lot of that has got to do with the standardization. But one of the proposals that we've made actually to the UNFCCC and a number of others is we can fund the growth of developers already in our portfolios to be able to access some of these new markets around a new arrangement linked into the NDC projects and come up with some new arrangement and work with the regulators to actually accomplish what we would call, an appropriate solution. But it's very clear that there is that this can be done in a Basel compliant way. That was one of the very first questions that were put out to the team that actually had to address that. And I think this whole issue coming to the second issue is it's a territorial issue. There is no reason why companies have to go through what they have to go through. I mean, to call it what it is, there is a philosophical difference between the views that the development community have about the role of the private sector in so-called development and the views of the investment community about our roles in development. We are long-term investors. We're creating economies. We're already involved in development. We're universal owners. In terms of the climate agenda, our primary focus in many respects, yes, we have to get optimal return and deliver against our fiduciary responsibilities. But, everyone's now beginning to think about how do we make sure that ESG and all these things are dealt with. For us, I mean, the E, is the NPV of S. In other words, you can't just go and invest in things for the environment just to get that tick in the box. We have to think about lives and livelihoods and all the rest of it. So we are one of the best long-term players to actually be able to participate and allocate for the medium to the long term, for the just transition. But there is this very strong relationship, this very strong narrative that gets peddled that you can't trust the private sector. You need a development finance institution or a development partner in the middle, when actually the real failure of the capital not being mobilized is the same institution that's advising the governments. So we think that it should just be democratized, data should be democratized, and we think access should be democratized. So whether it's that committee putting in money that needs a certain return on private capital mobilization, open it up to other parties. But there is right now, we're selecting the worst track record for private capital mobilization to lead in private capital mobilization on the climate agenda when we need a certain level of emergency. The Belém roadmap needs 300 billion from the private sector. At the same time, the multilateral development banks are being criticized for not being able to mobilize private capital. Who has been given the responsibility to mobilize the 300 billion? The same institutions. Where in the private sector, there are a number of institutions that could definitely get to the 1 in 5, if not the 1 in 10. And I'll close with the number. The number is that if, just to my colleague's point, he had an interest in the ratios, the data shows that if you can just move from the 20 to the 38 cents on the dollar to $5, which is half of the $10 mobilization for the $1, that again adds the $800 billion worth of headroom capacity to MDBs and $7 trillion in extra private capital mobilized. So these are big stakes. This is a big game. And this is where we think that the Commission would not lose anything by just understanding that for the future that we all want to share, we just have to move some roles around. And the institutional investment community is prepared to play that role. I think maybe the development partners may have to play a slightly different role, but we're not trying to take over the whole space. We're simply saying for the private capital to be mobilized at speed and scale, there's a way that we can take a slither of that into an asset class and make a contribution that we think would be, very strong. Thank you.
Thank you, Herbert. I think Roberto wants to react to that.
Okay.
Yeah, I would like to set an example and also offer some optimism. At the end, the finance community has, an obsession, and this is risk. It's always going to be there. And of course, from a finance point of view, we can play with risk and with return. We cannot make miracles, but there are some interesting solutions. When analyzing a project, I think it's been said, any financier is going to focus on having a reliable and credit-worthy off-taker and foreign exchange risk. And those two risks are very difficult to tackle, but things can be done. I'm going to set an example. For example, it doesn't belong to Africa. It comes from Latin America, from Argentina. Those two risks were there, and the Argentinian government made up a very nice solution. it set up a huge fund in dollars. And the fund offers guarantees to be in the place of off-takers if they didn't manage to honor the payment requirements and paid in dollars. So it was a nice way of tackling both types of risks. And that was enough to crowd in development finance institutions. The risk mitigant was enough, and there was a massive investment in renewable energy projects, above all wind projects in Argentina. But the solution was not good enough from institutional investors such as pension funds. Because after all, what is the sovereign rating of Argentina? It is far from AAA or AA. Who can put a AAA rating on the table? Well, the World Bank can, the European Commission can, but the resources are limited.
Thanks a lot, Roberto. We have to start wrapping up. It was a very interesting discussion. I've taken note that we need to work on the creation of pipelines of bankable projects, although Robert may not 100% agree with me and a few colleagues of the panel, but that we need to crowd in private sector money. That's absolutely essential, and we've seen here. Some of you mentioned ideas to make that possible, and also that policy regulatory reforms are necessary to provide predictability, transparency, which is key to bring in private sector investments. But these are my final words, but I would like to give Elizabeth, Andrew, and Samuel also the opportunity to say a few words to wrap up the session, as you had less bandwidth than my two colleagues here sitting left to me.
So my final words are that I think our rural electrification program here in Angola clearly shows that even in the most remote or challenging places, it is possible to deliver clean and affordable energy while protecting people, respecting communities, and improving capacity, local capacity. These are my final words.
So I think that we could actually transform this picture a little more if we get our governments to take more risk. And the reason why I think AfSEM-CMP is still putting $1 of project prep and sponsors should put $1 is just there's limited resource with the DFIs. So if we had enough of resources coming at a very early stage to support the pipeline of deals, then you could suddenly start to see more relaxation of some of these terms. So my encouragement is for governments to come through. You could have a hybrid of what Rodrigo mentioned, which happened in South America, or simply have sovereign wealth funds coming through to help with de-risking and taking more risk. And we move away from the safe game. Everybody is doing safe game, so we need to move away from that, especially for governments.
Thank you. A final word. I would like to come with maybe a simple idea. I think Africa has no issue with ambition. We only have an execution issue, I would say. Vision exists. Basically, ideas exist. The capital is here, and I think the bottleneck is really execution. So if this Africa-Europe partnership have something to do is really to be pragmatic. So like I said, standardization, de-risking tool, supporting early stage development. This is what we need, I think, to make this global gateway ambition become a reality on the ground. And I think all the ingredients are here. We have DFIs, we have operators, developers, governments. Everyone's ready, it seems to be. And we are also, as a developer, Hydroneer is ready, I think, to really contribute to what I think is the biggest renewable the biggest renewable opportunity of the 21st century. So let's just do it.
Thank you very much. So thank you all for being here, for having traveled to Luanda for this panel, and it was a pleasure to participate in this panel, and hearing from you what your suggestions for EU partnership and ideas to increase renewables and promote green transition in Africa. So thank you.